For years, Wirecard was held up as proof that Europe could compete with Silicon Valley, a German fintech success story, a payment giant. A member of the DAX index, sitting alongside companies like BMW and Siemens, regulators praised it, investors trusted it, politicians defended it, and yet, at the center of this respected financial institution was something that should never exist in any company anywhere in the world. The money wasn't missing. It was never there. $2 billion. Completely invented. And the most unsettling part isn't how Wirecard collapsed. It is how long it survived, while everyone who was supposed to protect the system either looked away or actively helped it stay alive. This wasn't a fast scam. It was a slow institutional failure that unfolded in plain sight. Wirecard didn't start as a fraud. That's important. In the late 1990s, it emerged as a legitimate payment processor, operating in one of the messiest corners of the internet: adult content, online gambling, high-risk merchants that traditional banks refused to touch. Wirecard stepped into that gap and grew quickly. This early success built a powerful narrative. The company positioned itself as a misunderstood innovator, a tech firm doing the dirty work others were too afraid to handle, and that identity would later become its strongest shield. As digital payments exploded, Wirecard rebranded itself as a clean, modern fintech. It went public. It expanded globally. It promised seamless payments across borders, currencies, and industries. On paper, it looked unstoppable. Revenues climbed. Profits looked strong. Analysts applauded its margins. And as the numbers grew, so did the trust. This is where the first psychological loop opened. When a company appears complex, international, and technologically advanced, people assume its success must be earned. Complexity feels like proof, and very few people want to admit they don't fully understand how a successful company actually makes its money. But cracks appeared early. Journalists began raising questions about Wirecard's overseas operations, especially in Asia. Reports suggested that large portions of revenue were coming from third-party partners. Businesses Wirecard claimed processed payments on its behalf in regions where it supposedly couldn't operate directly. The structure was confusing by design. Money flowed through subsidiaries, partners, and opaque accounts spread across multiple jurisdictions, and every time questions surfaced, Wirecard responded aggressively. Critics weren't answered, they were attacked. Short sellers were accused of market manipulation. Journalists were threatened with lawsuits. Regulators, astonishingly, often sided with Here's where the story takes a darker turn. Instead of investigating Wirecard, German authorities went after those questioning it. Short selling of Wirecard stock was temporarily banned. Complaints were filed against journalists. The narrative became inverted. Wirecard Zunti. The suspect, it was the victim. This is the second loop. When institutions publicly defend a company, skepticism becomes socially risky, doubt feels irresponsible, and silence becomes easier than resistance. At the center of Wirecard stood its CEO, Marcus Brown. Charismatic, controlled, always confident, he presented himself as the visionary architect of Europe's fintech future. Brown insisted the critics were wrong, that the business was sound, that the cash existed. And that assertion rested on one crucial claim. Billions of euros were sitting safely in trustee accounts in Asia, LDV third-party banks on Wirecard's behalf. These accounts were the backbone of the company's reported profits. Without them, nothing worked. And for years, auditors signed off on it. This is where most people assume the scandal becomes complicated. In reality, the truth was devastatingly simple. The bank statements confirming those billions were fake. The trustee accounts didn't hold the money. In fact, they barely existed at all. The documents were forged, the confirmations fabricated, the money was imaginary. But because the structure was international and the documentation appeared legitimate, the illusion held. Auditors relied on third parties. Regulators relied on auditors. Investors relied on everyone else. Responsibility dissolved at every layer. Around this point in the story, It's worth asking a dangerous question. How much proof do people actually need before they stop believing? Because by now, warnings were everywhere. Investigative journalists published detailed reports. Whistleblowers emerged. Internal inconsistencies piled up, yet the stock kept rising. Wirecard was promoted to Germany's most prestigious stock index. Funds bought in. Pensions invested. Ordinary people trusted that a company this visible, this regulated, this celebrated, couldn't possibly be lying about something so fundamental. This is the promise I want you to hold on to as we move forward. By the end of this story, you'll see exactly why Wirecard didn't need to hide the truth. The system hid it for them. The collapse didn't begin with a dramatic raid or a whistleblower leak. It began with a delay. In 2020, Wirecard announced it couldn't publish its financial results on time because auditors needed confirmation of those trusty accounts. Days passed. Then weeks. Finally, the admission came. 1.9 billion was missing. Not lost. Not stolen. Missing because it never existed. The company that had processed billions in payments each year had invented nearly a quarter of its balance sheet. The reaction was instant and brutal. Wirecard's stock collapsed. Trading was halted. Marcus Brown was arrested. Executives vanished. One senior executive was later reported to have fled and remains missing to this day. The Fintech champion evaporated almost overnight. Employees lost jobs. Investors lost everything, and regulators scrambled to explain how this happened under their watch. But here's the uncomfortable truth. Wirecard didn't fail because of a single criminal mastermind. It failed because modern financial systems reward growth stories more than verification, because complexity creates plausible deniability, because institutions prefer defending their past decisions over admitting mistakes, and because once enough people believe something is real, proving it isn't becomes nearly impossible. The money was invented, but the trust was real, and that trust carried the fraud further than any forged document ever could. This is why Wirecard matters far beyond Germany. It wasn't a startup operating in the shadows. It was regulated, audited, public, celebrated. It passed through every gate designed to protect markets and still collapsed. Which means the real lesson of Wirecard isn't about fintech. It's about systems that confuse legitimacy with truth. If a company can fabricate billions in cash while being audited, regulated, and praised, then the most dangerous scams aren't the ones that promise too much. They're the ones that look boring, official, and safe. Wirecard didn't steal money directly from customers in a traditional sense. It sold confidence, and the system paid for it. By the time the illusion broke, it was already too late. And that's the final loop. Fraud doesn't always announce itself. Sometimes it wears a suit, joins the index, hires the right auditors, and waits for everyone else to do the work of believing. If this story made you uncomfortable, that's the point. Because the mechanisms that allowed Wirecard to exist didn't disappear when it collapsed. They're still here. Still active. Still rewarded. And understanding how they work is the only defense you actually have.